increasing housing inventory, shrinking concessions, and a declining number of home sales and rentals. What could be the signs of an upcoming housing crash in 2023? And what if this housing crash imploded worse than the 2008 crash? The 2008 housing market crash is always one of those moments that lead many Americans to grit their teeth. Is it going to happen again? The developing crash in housing prices has profound implications for anyone looking to buy a house, as well as for investors in real estate. But there are several reasons that the current economic recession is different from the 2008 housing crash, which is mentioned by Delger Real Estate in their recent report, and we'll be explaining it along the way. This video will explain how the 2023 housing crash is not worse than 2008 while discussing their cause and effect situations. In this video, we are going to provide you with an in-depth understanding of the housing market crash of 2008 and compare it to the current state of the housing market. Fasten your seatbelts, folks. We are heading to the 2008 housing market crash causes and the similarities we are seeing in this upcoming crash of 2023. First of all, let's have a glance at the housing market crash that happened in 2008. A few events in past decades have infused that dreadful and notorious housing bubble burst in 2008. Undoubtedly, the housing market crash of 2008 was a catastrophic event in the history of the United States housing market, leading to a severe economic recession that impacted millions of Americans. The crash was primarily caused by a combination of factors, including the subprime mortgage crisis, high levels of debt, and a lack of regulation in the financial sector. On December 30th, 2008, the Case-Shiller Home Price Index reported the largest price drop in its history. The credit crisis resulting from the bursting of the housing bubble is an important cause of the 2007 to 2009 recession in the United States. A combination of cavalier lending policies and high market inventory stemming from the subprime mortgage blowback preceded a sudden drop in demand. Increased foreclosure rates in 2006-2007 among U.S. homeowners led to a crisis in August 2008. In many markets in the United States, home prices fell by 20% or more. Consequently, an economic sinkhole was born. According to Norada Real Estate, the subprime mortgage crisis was a significant contributor to the housing market crash of 2008. The Mortgage Credit Availability Index is a barometer on the availability of mortgage credit using guidelines from institutional investors who purchase loans through broker or correspondent channels. The higher the index, the easier it is for borrowers to get loans. The lower the index, the more difficult it is for borrowers to obtain a loan. Banks and other financial institutions gave loans to people who did not have the creditworthiness to repay them, which were then packaged and sold to investors as mortgage-backed securities. When homeowners began defaulting on their mortgages, the value of these securities plummeted, leading to significant losses for investors. In 2008, when these investments began to fail, many of these institutions faced insolvency, leading to a widespread credit freeze. Moreover, the lack of regulation in the financial sector allowed these risky investments to be made without adequate oversight. But now, getting mortgages has become much more difficult in 2023 as compared to 2008. Looking at a chart of the Mortgage Availability Index, you can see that it was very easy for borrowers to obtain a mortgage. As such, the health of the existing mortgages in the market is much better. This, combined with the equity that owners have in homes that are financed, means that homeowners will be less likely to default on mortgages. Additionally, many homeowners had taken out adjustable rate mortgages that had low introductory interest rates, which were later adjusted to higher rates. As these rates began to rise, many homeowners could not afford to make their monthly payments, leading to widespread defaults. The high levels of debt in the financial sector also played a critical role in the 2008 crash. But now, real estate is priced closer to the true market value. This graph shows annual house appreciation over the past 6 years compared to the 6 years leading up to the height of the housing bubble. Though price appreciation has been quite strong recently, it is nowhere near the rise in prices that preceded the crash. But before we dive further into the U.S. housing crash, please hit the like and subscribe button if you are enjoying the video so far. The housing market crash of 2008 led to severe economic consequences. Millions of Americans lost their homes, and many more lost their jobs as businesses struggled to stay afloat. Looking at the sales history of single-family homes in Bozeman, Montana, you can see that home prices were appreciating at over 13% per year before the correction that began in 2007. It is interesting to see that the number of homes sold started to decline in 2005 as prospective buyers started realizing that homes were overpriced. From the peak in 2006 to the bottom in 2011, median price declined 25.4%. And prices didn't get back to new highs until 2015. Here's a stark difference between these two periods of time. Normal appreciation is 3.6%, so while current appreciation is higher than the historic norm, it's certainly not accelerating beyond control as it did in the early 2000s. The housing market crash of 2008 highlighted the need for better regulation and oversight of the financial sector. In the years following the crisis, significant efforts were made to implement new regulations to prevent a similar crisis from occurring in the future. The Dodd-Frank Wall Street Reform and Consumer Protection Act were signed into law in 2010, which aimed to increase transparency and accountability in the financial sector. One particular sign that seems to happen in the house crash bubble of 2023 is when we see that even in a matter of months, the pandemic housing boom has turned into a rapidly spreading problem. The month's supply of inventory needed to sustain a normal real estate market is approximately 6 months. Anything more than that is an overabundance and will cause prices to depreciate. Anything less than that is a shortage and will lead to continued appreciation. Incredibly, recent reporting shows that home prices are now falling faster than they did during the run-up to the 2008 financial crisis. Prices are falling as much as 4% per month in some formerly red-hot markets. 30-year fixed mortgages are at 7.3% and rising after the Fed meeting. Mortgage applications for purchases are considered to be the best leading indicator of future sales that will close in the months ahead, and they're down 42% year over year and continue to fall each week. And this decreased demand is coming just as a tsunami of new supply is about to hit the market, with over 1.7 million privately owned homes currently under construction. All these economic models will show you that compared with sluggish wages and skyrocketing interest rates, home prices are as much as 75% overvalued in formerly hot housing markets. But all these claims are just one side of the picture. As we turn the coin, we can see that there were too many homes for sale in 2007, which caused prices to tumble. Today, there's a shortage of inventory, which is causing an acceleration in home values, as claimed by Keeping Current Matters. The monthly inventory of home sales is now low by 3.1% in 2023, as compared to 8.2% in 2007 and onwards. The affordability formula has 3 components: the price of the home, the wages earned by the purchaser, and the mortgage rate available at the time. 14 years ago, prices were high, wages were low, and mortgage rates were over 6%. Today, prices are still high, wages have increased, and the mortgage rate is about 7.3%. That means the average family pays slightly less of their monthly income toward their mortgage payment than they did back then. Here's a graph showing that difference of 25.4% in 2006 and 15.5% now. Let's see some differences between the housing market crash in 2008 with the current situation. Although there are some similarities between the current state of the housing market and the conditions that led to the 2008 crash, several significant differences exist. Today, there are stricter lending standards, more diverse housing options, and a tighter regulatory environment in the financial sector have made the current housing market more stable. The current housing market's supply-demand dynamics are also different, with a shortage of homes driving up prices. These factors, combined with demographic and lifestyle changes, suggest the current housing market is less vulnerable to a crash than the market was in 2008. One key difference is the stricter lending standards that are now in place. Banks and other financial institutions are now required to ensure that borrowers have the creditworthiness to repay their loans. Moreover, the market has become more diverse, with a more extensive range of homes available for sale. Additionally, there is less speculation in the housing market than there was in 2008, with more homebuyers purchasing homes to live in rather than for investments. Furthermore, the Federal Reserve has been more proactive in implementing policies to prevent a housing market crash, including keeping interest rates from skyrocketing and providing economic stimulus to support the housing market. Another significant difference between the 2008 housing market crash and the current housing market is the supply-demand dynamics. In the years leading up to the 2008 crash, there was an oversupply of homes, fueled by speculative home construction and lax lending standards. This led to a glut of unsold homes and falling prices. In the 2008 housing bubble, homeowners were using their homes as personal ATMs. Many of them immediately extracted their equity once the house was built. But now, prices have risen nicely over the last few years, leading to over 50% of homes in the country having greater than 50% equity. Homeowners are not tapping into their equity as eagerly as the last time, as they had learned their lesson in the process. In contrast, the current housing market is characterized by a shortage of homes for sale, which is driving up prices. The pandemic has also created new dynamics in the housing market, with many people opting for larger homes in suburban and rural areas, which has further increased demand. We can conclude this discussion by saying that we certainly can assume a crash is inbound, seeing the huge declines rolling down the tracks again. But many other indicators and factors are working to affect the market in a composed situation. If you already bought a house with a low mortgage rate before the assumed housing bubble crash, then we can conclude that you don't need to worry too much because you are safe. But if you are looking to buy a new house, you should wait for a better time. Thank you guys for watching. As always, please make sure you hit the like and subscribe button if you enjoyed the video, and leave a comment below letting me know what your recommendations are to avoid this upcoming housing crash.